Okay, so let's talk about the big thing for the income statement, which is determining operating taxes. Now we have a whole chapter on taxes, so I'm kind of going to go a little bit quick here. I'm not going to spend a lot of time trying to explain it because we have a whole chapter on taxes and it's more complicated than just these few slides. But I want to give you the overview of what we need to do when we are determining operating taxes. Okay, so the first thing that we need to do, and I actually showed you this in the DCF example, I showed you this table. We need to find and convert the tax reconciliation table. Okay, so this is a table that's in the footnotes of to the 10K. It is going to describe the taxes that are paid out. It's called the tax reconciliation table because it's going to tell you how the final tax number on the income statement is determined based on all the different tax sources that the firm has to pay. Okay. Then we're going to determine the taxes as if it was all equity. So we're going to try and find the marginal tax rate so that it doesn't include, we don't have any interest tax savings included in our tax rate. And then if we have any kind of operating tax credits that we might get, say, because like the most common one is an adjustment for foreign tax rates, but like the second most common one is like you get a tax credit to locate a research facility somewhere, or you get a tax credit to put a warehouse somewhere, and that's based on you continuing to operate those businesses there. That's an operating tax credit, and we want to include that in our operating tax rate. Okay. So what we're looking for is to generate a tax rate that is only based on the firm's operations, so it might include some operating tax credits. Otherwise, it's the marginal tax rate for the firm's profit as if it was an all equity firm, did not have any debt. Okay. So here's an example of UPS's tax reconciliation table, and this is for that same period of our problem. This is 2011, 2012, and 2013. You can see that the reconciliation table breaks down the taxes paid, starting with the federal income tax rate, which at the time was 35% for UPS. Now it's 21%. Then they pay some state and local taxes in the US, so 2%. Then in 2012, they didn't pay any, but in 2013, they paid 2.1%. So this is additional taxes that they paid to the states. Then they have a non-US tax rate differential. So they operate in other countries, and because of that, they might get some kind of tax credits or savings from paying those different rates. So income that they earned in, say, Ireland would only be taxed at a 20% rate. So they have to, they would not pay US taxes on that income. They would only pay Irish taxes on that income. So that's why these are negative here. They are adjusting the effective rate for their total consolidated income downwards to reflect the fact that they paid less taxes by operating in lower countries with lower tax jurisdictions. Then they have some non-deductible, non-taxable income, so they're reducing their tax rate because of that. They have some federal tax credits. They're here, like in 2012, they have a big federal tax credit, 7%, reducing their tax rate by 7% because of a credit. They've got other, which again, we'd have to go find out. But what that ends up with them being is they have an effective tax rate. And in 2011, their effective tax rate is about the federal statutory rate. It's 34% instead of 35%. In 2012, it's much lower. They only pay 17% taxes on an effective basis, even though what they're charged is 35%. And that's due to these big tax credits that they got. And then in 2013, they again are back up to about 34%. So they're paying about the statutory rate. UPS, based on their business, is not that able to avoid taxes by engaging in some shenanigans that other companies like Amazon or GE are able to. Right? Now, so first step is we find this table. Usually the table is also going to include this percentage figure in dollars. If it doesn't, we need to do it ourselves, which is easy. We just multiply the earnings before taxes by each of these rates so that we recreate this table in dollars. Right, so that's all I did. That's all this is here is you multiply the earnings before taxes in 2011 down at the bottom by 35%, and you get $2.22 billion in that other table. So we want to recreate the table so that we have it in both rates and in dollars. Right. Then we are going to sort of recreate, what we're after is the company's marginal rate. And this is usually not that complicated. It's typically just the statutory rate plus the state or local taxes, right? So this is a good way to proxy. Again, we'll have a big chapter on this where we go into detail, where we talk about different ways to do this and how we can make mistakes and how we can avoid them. But here's just a general proxy. The marginal tax rate. So marginal means for the next dollar UPS earns, what is the tax rate going to be in the US? It's going to be the state rate plus the federal rate, so 37%. Because the state differential was 2% in 2011, the federal rate was 35%. So the marginal tax rate is 37% on any additional dollar. So we use this to compute the adjusted taxes on EBITDA. And we're using EBITDA here and not EBT because, again, we want to remove the interest tax shield. We want to calculate this as if the taxes were paid on an all equity, so just on operating profit. And then we are going to try to go back to the dollar-based reconciliation table. We're going to look for any other operating taxes. Now, UPS had some operating taxes. They had some foreign tax rate differences, so they paid lower taxes than on the income that they earned in other countries, and they had some US tax credits that were based on their operations. So both of those should reduce that marginal tax paid. And so we would just take that dollar value of those two things, right? So the foreign tax rate difference was 87 million, and the tax credit in 2013 was 80 million. So that would reduce the taxes that UPS would have paid. It didn't actually pay the marginal rate. It paid a lower rate, effective rate. And so that's how we would calculate our operating taxes. Okay. Now, again, I went kind of fast. This is not the full explanation. We will have a chapter on this, so I don't want to. You end up repeating yourself a lot in this class. I try not to do that too much. This is just an example of what we need to do to adjust the tax rate so that we are calculating the appropriate tax rate when we calculate NOPLAT. Okay, and then ultimately what we're after is once we've calculated, we've reorganized the financial statements, we've calculated NOPLAT and invested capital, we can calculate ROIC, we can identify the firm's return on invested capital, which is a really valuable tool. But ultimately what we're after in terms of valuation is what's called free cash flow. And free cash flow is all the money that's left over after the firm has generated revenue, paid all of its operating costs, and all of its operating taxes. That's NOPLAT. Then we add back any non-cash expense like depreciation or amortization, and we get what's called gross cash flow. So this is all the money that's left over after the firm has depreciated its assets, but also paid all its operating expenses. Okay? Operating expenses, that's going to be all the parts and supplies. It's going to be all the salaries for my employees. It's going to be utilities for my and maintenance on machinery, all that kind of stuff. That's all been covered. Any money left over is called gross cash flow. Gross cash flow is then available to the firm to reinvest in the firm. And it can reinvest in lots of different ways. It can reinvest in working capital. So for instance, it could put money into, say, operating cash. Maybe the firm needs more cash in its savings account. It ran out of cash at one point. It wants to build up its savings account. So it can take some of gross cash flow and build up its savings account. That's an investment. It can take some of gross cash flow and it can build up its inventory. That's another investment in working capital. We ran out of inventory, or we were too close to the margin, so we want to hold a higher amount of inventory this year than we did last year, so we're going to build a couple more things and put it in inventory. That's an investment in working capital. It can also invest in fixed capital, right? So it could buy new fixed assets, real assets, like a new truck or a new delivery vehicle or a plane or some new machinery. It could upgrade its computer equipment. Those would all be investments that could come out of gross cash flow for the year and be reinvested into the firm. Anything that is not reinvested, all the cash that is left over is free cash. This is cash that the firm did not have a use for in the current year for its operations, and it can now be returned to investors who have provided the capital to run this business from the start. Right? So gross cash flow minus gross investment is free cash flow. Right? And the other way to think about this is that formula that I showed you earlier in the slides, which is NOPLAT minus any non-cash charge like depreciation or amortization minus any change in the investments of the firm, in the invested capital of the firm, gives me free cash flow. Okay? And this is the cash flow that's available to pay back. Now, we're going to pay some of that back in the form of interest. We're going to pay some of that back in the form of dividends. We're going to pay some of that back in the form of paying off the debt, right? So paying off debt comes in paying off interest and in paying off the debt itself, principal. Right? So all of that is going to be ultimately returned to investors. Free cash flow is returned to investors, either by dividends or by paying off my loans. Right? And this is exactly how it should be. Right? These are the investors, are the people who have provided the funding to buy the assets and start the firm's operations. And they only do that because they expect to be returned. They expect a return. They expect to get their money back. Debt holders only give you a loan because they want the interest on the loan paid back. Equity holders only buy shares because they want to share the profit, and that's the dividends. So free cash flow is a very valuable thing for everyone in the firm to recognize, because it's how investors know whether there's enough money to get paid back. It's how investors value the firm by how much free cash flow they're generating. And it's how management knows that they're doing a good job. Right? So free cash flow is the ultimate result of this reorganization, and it uses NOPLAT and invested capital. And so we have to get those things right, or we're going to get free cash flow wrong. Right? Now, there's some advanced stuff, and we'll talk about some of this a little bit later. So this is some stuff that I'll sort of continue to put off a little bit. We'll have another chapter here. But for instance, I'll probably work a really short example to demonstrate these, because I think they're very complicated, or they seem very complicated until you sort of see how they actually work, all the steps. Okay, but for instance, research and development. If you're a pharmaceutical company and you have, again, half your expenses devoted to R&D, then this is a significant operating part of the firm, is doing research and development. And all that we would want to do is that we would want to treat R&D as the asset that it is. Okay, so typically R&D is not treated as an asset, it's not an intangible asset, until something tangible has been made. So R&D is not treated as an asset until the research and development turns into a patent or turns into a product, and then the product is treated as an asset. Okay, what we'd like to do is treat the whole process as an asset, because the process is an asset, the lab is an asset, the research agenda, the people working for us, they're all assets, and we'd like to be able to treat that as an asset. So typically what happens is R&D is only on the income statement as a subtract R&D expense. But what we'd like to do is what's called capitalizing this. Capitalizing means to add something to the balance sheet as an asset so that it is treated as capital. So we would value the research and development, put it on the balance sheet as an asset. We would say R&D asset, intangible, and we would put it on the balance sheet. So in our reorganized balance sheet, we would put R&D there. And then we would remove the R&D expense from the income statement and instead replace it with an amortization of the R&D asset that we put on the balance sheet. Okay? So we would, in our reorganization, we would put in a totally new asset that wasn't on the balance sheet. We would remove an expense that is operating expense, and we would replace it with amortization of the asset that we added, and we would treat that amortization as operating. Okay? So you saw this a little bit in our UPS example where they had amortization of capitalized software. This is another intangible asset that they added to the balance sheet themselves because they said they wanted you to know how valuable this software was. And then instead of treating that software as having an expense to maintain it, they just amortized that asset, which is, again, amortization is the equivalent to depreciation for intangible assets. They amortized that intangible software as the expense, and we treated both of those as operating. Okay? So we would want to do the same thing for R&D. And again, I know this concept is kind of confusing, so I'll show you an example. I'll write out a quick example where I actually show you all the changes and what we're looking like. Operating leases, we would do the same thing. The company is leasing a ton of planes to deliver all their packages. UPS is leasing, 20, 30 planes to deliver all their packages. They are using these planes as if they were the assets of the company. However, those assets are not on the balance sheet. And the only record we have of them using those assets is the rental expense on the income statement. What we want to do is treat the company as if it owns these assets that it's simply renting, because they are a big part of the operations of the firm. If the company couldn't rent them, it would need to buy them. Okay? So what we would do is we would value the planes and we would put that value on the balance sheet. Again, on our reorganized balance sheet, we would add an asset, planes, operating leases, planes, something like that. And we would add an equivalent liability, because if the firm actually owned these planes, it would have to pay for them using debt, most likely. So we would add the equivalent liability to the balance sheet. And this would be the loan that we would need to take out to buy the planes. Then on the income statement, we would remove rental expense and we would put in the interest and the interest expense on the loans. Okay, so we would say, okay, if we weren't leasing these planes, we would have to borrow to buy them. And if we did that, we would want to remove it. Now, the big reason we want to do this is that the company has played a little trick on us with operating leases. What they've done is they have leased these planes so that the asset and liability are no longer on the balance sheet. And that reduces our invested capital. But they have now on the income statement, they still have the revenue generated by those planes in revenue. And we're treating that as operating revenue, even though there's no corresponding operating asset in the balance sheet. Now, we are removing rental expense, but that is not typically going to be the same thing. And so we want to make sure that what we want to do is make sure that the revenue and the assets that are generating the revenue are both accurately represented in our reorganized financial statements. Okay, so this is kind of tricky. There is actually a law change that made operating leases harder to do. So we'll have a chapter on this. I posted some slides on some Wall Street Journal articles on this about the companies that are still affected by this. But this is not as common anymore, but it is something we have to be aware of when we're doing our historical 10 years of historical data. And then you might have things like recognized pension gains and losses. These are typically included in cost of goods sold. So if we make money on our pension plan, so a pension plan usually works by all the money that the employees have paid into the pension plan and all the money that the employer has contributed to the pension plan, the retirement plan for their employees, is then invested in the stock market. And they hire a bunch of actuaries, they hire a bunch of people to determine how big the pension plan needs to be in order to cover all of the retirement expenses for the employees. And if the stock account for the pension plan exceeds that value, they consider it a pension gain, and they use that to reduce their expenses. And if there's a loss, then they consider that a cost because the employer has to contribute more money, and so they put that into cost of goods sold. What we want to do is try to find the footnote that talks about this and make sure that we take that out. That's not operating in nature. Now, in the example I told you, I think these things should be considered operating because the pension plan was promised to employees as a part of their employment. So to me, that is operating in nature. That's not the standard when people do this. So you should also not treat them as operating unless that changes in a broader way. So we'll talk some more advanced issues like this in later chapters. So we won't go into any more detail here, but there are some more advanced issues, and there will always be some more advanced issues. That's sort of part of the nature of these projects is we're always going to run into a new problem that we haven't really dealt with before, and we're going to have to try to think about it and figure out a way to correctly identify this problem and address it. Okay. All right. So that's all I have for this chapter. We'll pick back up next week.